Oh man, the internet. What a time to be alive when that came out. I mean, that's just so commonplace. Like, but that back in the day, right? Dial up and your AOL Instant Messenger. Man, what a time. With the extremely awkward tag or name. I don't remember what we call them. Screen names.
Remember the discs?
The floppy disks.
Yeah, well, the ones AOL
Oh
sent.
yeah, the CDs that you would get to. Yeah. That's right. They would send them to you in the mail. Like, here, it's your AOL browser. Download it now, and you'd put it in, and oh man, AOL is the best. I saw that the other day that somebody was like trying to explain to somebody that they were older than Google, and like young people just don't understand that Google was like 1998 is when it came out. I mean, it was not that long ago, really and truthfully, but people can't even imagine a world without it anymore. It's craziness. Let me ask you a question here, folks. Right, we're talking about the solicitation laws, but let me ask you a question, just in kind of the similar groupings of all these different things that we're discussing. Oops, or give you the answer, one of the two. A firm usually seeks a 6% commission to list properties for sale. Potential new client does not wish to pay that percentage. The firm can do which of these things, folks? Ask Jeeves. That's right, Lena. Yeah, whatever, Brooks. Ask Jeeves was the thing. Yeah, and I kind of warned you about this one just a second ago. Even though I already gave you the answer, I want you to kind of, still process through it on your own. We are allowed to negotiate freely. We do not have to change our price just because we reduced it for one person. Of course, we can negotiate with one person, and then, the next person, we can go back and forth. It doesn't really matter, as long as we understand that fees are negotiable. There are no fixed prices. No boycotting, no allocation of markets, no violations of the Sherman antitrust laws. Those will get us in trouble. Now, while we're sitting here talking about the seller side, or the listing agreement, should I say, let's just talk about the total piece of this altogether, folks. When somebody decides that they want to sell a house and they reach out to us as a real estate broker, and they very often or very much may consider talking to multiple agents simultaneously to interview and see who they're going to hire. And of course, that would involve what we call a pre-listing meeting, or what we sometimes just refer to as a listing appointment. So there's certain things that we say that when we get hired by a seller, we want them to provide to us. In the real world, a lot of times sellers don't have these, and so we end up hunting them down ourselves when possible. But we still say that we want the seller to provide them, and so one of them is a copy of the seller's deed. We've talked about deeds already. The deed is going to show that they, in fact, are the owners of record, right? The most recent grantees in the ownership chain of title that we talked about. If they don't have a copy of it, it's public record. We can find it in the Register of Deeds. A copy of their survey. Remember, we talked about surveys. That'd be a licensed surveyor going out and finding the property lines and checking it for any encroachments, easements, floodplains, things of that nature. Surveys are not public record, but if the seller has a copy, it is advantageous, so we can take a look at it and evaluate it for the pre-listing. Of course, any copies of those restrictive or protective covenants, those private land use controls set by the previous property owners, no chickens, no fences of a certain height, no whatever. And of course, their loan payoff. And we're going to talk about the loan payoff more in the financing, but we need to make sure that they have enough equity in the home that when we list it and we get a certain price, that we know that they could potentially pay it off and then have enough to pay their commissions and everything in between. So all of these things come up. Now, as you might imagine, folks, if we're talking to a seller at a listing appointment like this, we should have already given them one thing. And what is that? There you go. The working with real estate agents disclosure, because we are going into confidential territory. Their loan payoff, their reason for selling, these things are confidential territory. So we need to make sure that we have gone over that with them. And so we review agency with them. We talk about what the whole process is going to look like. And then, of course, if they're going to hire us, they will sign that listing agreement. Other things that are going to happen at this listing inspection: we're going to walk through the property. We're going to talk about any potential repairs that need to happen. They're going to point out features, things that may be pertinent, practical to listing the home. Of course, if there is any fixtures that are going to stay, personal property that's going to stay. Very big conversation, folks, on the test. If I say, what would be a very important job of a listing agent? Discussing fixtures and personal property with the seller to ensure that they are comfortable with what stays and what goes is going to be a big part of our job. Of course, gather all the data for the property so that we can list it in the MLS and advertise it appropriately. This is just matter of fact stuff, folks. Nothing is just too crazy in depth here. It's just miscellaneous things that we're just discussing in the listing. Marketing plan, how we're going to market it, where are we going to advertise it, what are we going to charge, as we just said. Of course, talk about septics, if it's on one, if it's on sewer, what type of water source. If it is on septic, remember we said that would dictate how we can market the property for bedrooms' sake. And we would look at the septic permit and the county health and or environmental site, if you will. Of course, construction, alterations, repairs, determine if a potential short sale situation exists. I said we're going to talk about that in the financing section, and we figure that out by discussing what their payoff is. Verify acreage and square footage and all of that fun-filled jazz. Now, I think it's going to come up in just a second. We're going to talk about what we refer to as the residential square footage guidelines. And there are certain pieces that you're going to have to be able to answer on that for the North Carolina side of the test. And I'll show you more of what I mean in just a second. Let me actually clarify something while I have this slide up. Because I think it'll come up in a second, but if not, just in case. We are expected in North Carolina as real estate brokers to have the requisite knowledge to measure a house. That is a skill that we have to have. And so we teach you that in post-licensing. Not really the formal, aspects of it here in pre. It's not the place for it, but we teach it in post. And they do go on to say that we are allowed to hire somebody with a greater skill set than us, like an appraiser, to measure. We don't legally have to be the ones that measure as long as we know how to. And so we are expected to be able to verify square footage, but we are not expected to be able to verify acreage. That is outside of the scope of a real estate broker. So we are allowed to rely on surveys and tax records and deeds for acreage, but we are not allowed to use things like tax cards for square footage. We have to hire somebody to measure it, or we have to measure it. So here's the reminder for some things we've already talked about in great detail. Folks, I told you that one of the most testable pieces of contracts is, well, how do they end? And of course, right now, we're still talking about the listing side of things. And so specifically listing agreements, how do they end? And just like any other contract, we said completion or fulfillment of purpose. So if I sold your house and you paid me, we're done. That kills our listing agreement. Of course, expiration, because we have to have that definite expiration date. If we have not sold your house and the date hits and it dies, it's dead. You are not allowed to have an automatic renewal in listing agreements. Of course, we've said before, mutual agreement terminates every contract, including listing agreements. Breach by one party. Remember I told you be careful on the test. If somebody decides they wake up one day and they just want out, they cannot just get out. However, if one party breaches and you can arguably prove that they are not doing what they were supposed to do, then the non-breaching party typically has an out. So if the agent is not marketing your property, not answering the phone, not representing you, arguably you could get out of it, and then vice versa. If the seller's not doing what they were supposed to do, they could arguably get out of it too. But the breach would be the trigger, not just one party wants out. Of course, we talked about destruction, condemnation, operation of law, the property being taken by eminent domain, the property burning to the ground, the property being part of a foreclosure, anything like that could kill a listing agreement. If there's no house to sell, then it's dead. Remember, the property-specific agency contracts do die with destruction of the property or loss of the property or things of that nature. And then, of course, the other one that you've got to be very careful on is death or incapacity of either party. Why do you have to be careful on that one? There you go. Bill says the firm. Because if the seller dies, that kills a listing agreement. But if the individual licensee dies, it does not if there is a firm, because the firm is the agent and the firm is alive and well. What would change that? Yeah. A sole a meteor, there you go, Bridge. A sole proprietor. If there is one person, one person, sole practitioner, the actual individual, or sole proprietor without any other affiliated licensees, that would change things. Also, please remember, firms can die too. If a firm loses its BIC, it's dead. If it loses its qualifying broker, it's dead. If it, files bankruptcy, if it loses its firm license, firms can die. So don't get confused on that. But if death of the parties, right, would kill an agency contract as well, you just got to make sure you understand who the party actually is to decide whether or not it kills it. Now, we've already talked about this as well. Destruction of the property, okay, I told you, would kill property-specific things. But yet again, a couple words of caution here, okay? A listing agreement is property-specific, so destruction of the property kills a listing agreement. Property management agreements are property-specific, so destruction of the property would kill a property management agreement. Leases, same thing. Buyer agency agreements are not property-specific, and so destruction of a property would not kill a buyer agency agreement. Because we could just go find you another house. But here's the big word of caution, folks. And remember what I told you. When you're answering questions on documents, you've got to realize, are you answering a question on contracts in general, real estate contracts in general, or an exceptionally specific real estate contract? Like one of the listing agreements versus another one, or a sales contract in general versus a very specific sales contract. And let me explain what I mean here, folks. If we were dealing with a sales contract in general, and the property was to burn down, that would kill most sales contracts. Why? It's called impossibility of performance. Because a contract is a set of promises. And so in a sales contract, the seller promises to give you a house, buyer promises to give money. And so if the house burns down, is that possible anymore? Not as contemplated, right? Because you're not going to be able to meet the time frame. But listen very carefully here, folks. Destruction of the property would kill a sales contract in general. But when we get into a later section, we're going to talk about a very specific North Carolina sales contract called the Standard Form 2T. And that specific contract would not automatically die with destruction of the property. Why? There is a specific provision in there that states it doesn't. So there is the default setting, and then there is exceptions to everything. And that's why I'm telling you, you've got to be so thoughtful on paying attention to what we're asking you about. Because it's a very different question. Does destruction of the property kill a sales contract? The answer is yes. Does destruction of the property kill the specific Form 2T? The answer is no. I know. Isn't this fun? So here's where we get into the residential square footage guidelines, folks. And there is a link to it in the online materials in the LMS, but I'm actually going to show you, where you can find it as well. If you go back to the Real Estate Commission's website, and yet again, where we always tend to go is publications. Right here under guides, the residential square footage guidelines. This is how we look at heated living area in North Carolina. These are guides that were put out by the commission for us on whether or not we can call it heated square footage. Now, do understand that there are two different standards. Appraisers use something called the ANSI standard, which is the American National Standard Institute. We use this. Neither are wrong. They're just slightly different. And so there are 3 criteria that you need to know for the test on what is considered heated living area. In other words, what allows us to market it as a living area in North Carolina. And so the 3 criteria are, number 1, heated. And when I say heated, I mean by a conventional permanent heat source. You cannot count fireplaces because they're not sufficient to heat the whole house. You cannot count things like portable heaters. It has to be permanently attached heat source. So heat pumps, baseboards, solar, radiant, all of these would be okay. So it has to have a permanent heat source. Folks, AC is not required. As crazy as that sounds. AC is not required. It has to have a permanent heat source. Criteria 2 is what we call finished. Finished is like finished to the rest of the house, right? Standard finishing material. Things like, Brooke says geothermal. Yeah, arguably maybe, if it's permanent and it's sufficient. Basically, the way that it has to be able to heat the property to at least 60 degrees when it's 20 outside. If it can do that, then maybe, if it's permanent. When we say finished, it's standard finishes, right? Paneled walls, drywall, tile, carpet, hardwoods, sheetrock, things of this nature that you would consider standard finish, not like concrete floors that are, completely bare, not studs, things of that nature would not be sufficient. And then the other part of finished is the ceilings have to be at least 7 feet tall, except in areas where there's ductworks or pipes, it has to be at least 6 feet 4 inches. That's what it says right here. And then in rooms like bonus rooms with sloped ceilings, you can count them so long as at least half the room is 7 feet tall. And you can count all the way up to the place where the slopes are at least 5 feet from floor to slope. So in other words, if you had the slopes kind of like this in the room, super artistic, and let's say that at least half of it was 7 feet, but these slopes were only 4 feet, you would have to come away from the wall where it was at least 5 feet from the slope to the floor, and so you would not be able to count this area in the living area of that room. So finished includes 7 feet tall, and then of course these special circumstances, standard finishes. And then of course the last criteria is directly accessible from other heated living area. So as long as you can get to it from other rooms in the house, you can include it. What does this mean? You can include it in the total marketable number. If you have a finished room above your garage, but the only way to access it is through a staircase in the garage, even though the garage is attached, you can't count it as heated living area because you had to go out of your finished house into your garage and then go upstairs. Can't count it. Detached garage, couldn't count it. Pool house, couldn't count it. Don't confuse it. Sure, that adds value. Sure, that adds utility. But what we're saying is if it does not meet these 3 criteria, you can't market it as one flat number in the MLS and say like 3,000 square feet. So if you had like a detached garage with 400 square feet of finished area and the house is 2,600, you would have to advertise it as 2,600 square feet of living area and then 400 square feet of other area above grade is what we call it. So those are the 3 criteria. Now, the other things that you need to know is the terms what we call above grade and below grade. Grade is a fancy word for the soil. When we're talking about grading a lot, we're talking about leveling it to be built on, changing the pitch, so for drainage and things of that nature. And so if you ever hear somebody grading it, that's where they go out with tractors and kind of get it ready to build on. And so if you've got something like a flat lot and a crawl space, and then the house is built on top of it, or even a slab for that matter, this is all considered above grade square footage. Okay, anything that's above the dirt is above grade. If you've got a wonky shaped property that kind of has like a big kind of drop to it, and it ends up with like a basement in the back, and so you enter on the one level and then you can go out the door on the back, and let's say that there's a finished room here. Anytime that there is dirt adjacent to any wall, you have to call it below grade. And I mean any wall, even if the vast majority of it is above the dirt. If there is dirt outside of any living area wall, you have to call that below grade square footage. And that's going to be a very testable thing. Above grade versus below grade is definitely going to be on the test, the national test for sure. So we are talking about the residential square footage guidelines. And of course, this is a North Carolina thing on how we look at heated square footage. And so the 3 criteria, we said permanent heat source, finished, and directly accessible from other heated living area. And so we also talked about above grade versus below grade. Above grade is living area completely above the dirt. And any time that there is even a portion of dirt on the exterior wall of living space, it has to be considered below grade. And that's really the biggest difference between the ANSI standard and this standard is we allow you to put the numbers together, but it's best to disclose that some is above grade and some is below grade. The ANSI standard always keeps them separate. Is that something you need to know? Probably not. The only other thing that I'll point out to you, and we've really already talked about the math, is that if you were dealing with what we would call a true 2-story home, folks, let's just say that you had an aerial view of a home and it was a 50 by 30 rectangle. We did the math when we were talking about lot sizes and, of course, the 43,560 and area calculation math is what we called it. And so we already did a lot with area calculations, and the measuring houses is the exact same, just area calculations. And so if this was a 2-story house, meaning there is the same amount of living area on the first floor and the second floor, you would take your 50, multiply it by 30, which would be 1,500 square feet, but then you would just take it and multiply it by 2. That's how you would calculate living area of a 2-story home if it was same living area on the first and second floor. And so what I'm really getting at here, that it also may be testable, the stairs, if the opening to the stairs is the same on the top and the bottom, like standard opening stairs, no vaulted ceilings, no catwalks, stairs count on both the first and second floors. Okay, you do not need to do anything special with the stairs. If we had something like a vaulted entryway, obviously you would not be able to count that as living square footage on the second floor because there is no floor there. But you're not going to need to know that detailed level for pre-licensing. You just need to know the 3 criteria that make it heated square footage, that the stairs count on both floors, the above grade and the below grade. That's what you really need to know about this. A couple more notes just to, kind of put a bow on this. If you were dealing with measuring, folks, and I guess let me pull that visual back up because it's easier to explain. And I guess I should have said it while I had the picture up. The measurements are based on exterior measurements, whether you realize this or not, which means when we measure a home as real estate professionals, we're actually measuring the outside of the house. The tape measure or whatever we're using is up against your vinyl, your brick, your masonite, your hardy board, your whatever it may be. We measure from the outside. And so, for example, if you're looking at this home right here, it's kind of got this covered porch. We would actually go onto this porch and measure from this corner to this inside corner. And that would be our first line right here. And then we would just continue around the property measuring the outside and, of course, break it into smaller geometric shapes in order to calculate square footage. Because this is not just a plain rectangle, but you could break it into 2 smaller rectangles. So rectangle, rectangle, and you could do the calculations. You're not going to have anything in depth in any way, shape, or form. But the last note that I'm kind of getting at is it is based on exterior measurements. You have to know that. And so sometimes out of necessity, if you can't get good exterior measurements, maybe for like a bonus room on the second floor where that's all you have on the second floor, and so you're not going to climb a ladder to measure the outside of it, you might potentially measure inside, but then you would have to add 6 inches for every exterior wall to make up for the fact that you didn't measure from the outside. What is that accounting for? The studs, the framing, the insulation, the drywall, all the things that you would not normally have to account for. So if and only if you had to measure something from the inside, you would have to add 6 inches to extend as if you had measured from the outside. That's what that means there. Now, in North Carolina, square footage is not a material fact. It is not something that the Real Estate Commission requires us to disclose. However, the MLS, the Multiple Listing Service, does require us to disclose it in North Carolina. And so the stance of the commission is, if we're disclosing it, it has to be accurate. So because the MLS requires us to disclose it, we have to make sure that it's accurate. And again, I don't necessarily know that this is going to be something on the test. There is what we would consider a 5% margin of error, which is basically where we say, okay, well, because of rounding, because of certain things with measurements, if you're within a 5% discrepancy of a true number, then you're not going to be in big old trouble. That's what it's getting at. We're not going to, throw the book at you, take your license or anything like that. When I say the 5% margin of error, what you got, Brooks?
Wouldn't you need to add a full foot to account for the exterior walls? Because you got one exterior wall on one side and one exterior wall on the other.
Yeah, you would add 6 inches to each side, which would be a full foot. So let's say that you were measuring like a bonus room. And let's just, for the sake of, making it easy, say that these are, it's a sloped room like over a garage. So these are sloped walls. In other words, that means they're not exterior because there's attic space in here and attic space in here. And so you're going to measure internally here and here. And this is an exterior wall. And this is an exterior wall. Let's say this was 22 feet from inside to inside. You need to add 6 inches here and 6 inches here for both exterior walls, which would be like saying it's 23 feet. Yeah. So that 5% margin of error that we're talking about, like I said, it's just basically we're not going to take your licenses if you're, plus or minus 5%. So if you're dealing with, 2,100 square foot house, 5%, 105 square feet plus or minus, you're not going to lose your license if you're off by anywhere from less than 100 square feet. What you got, Beverly?
Are non-permitted additions broken out separately in the listing, or are they included?
Good question. If some space is unpermitted, but it meets the residential square footage guidelines, you can still count it as heated square footage. However, unpermitted is a material fact. So let's say that you had a property that was 3,000 square feet total, but 3,000 or 300 square feet of that was non-permitted. You would have to disclose 300 of that is unpermitted square footage. So you can still call it heated living area as long as it meets those 3 criteria, but it still has to be disclosed that 300 of that is unpermitted. Does that make sense? Also, here is where we talked about the above grade versus below grade, right? Anything above the dirt is called above grade. If any of the dirt is it's below ground, just sounds too literal. If any dirt is adjacent to any of the living area walls, even like by this much, you have to consider it below grade square footage. Also, on a funny side note here, I don't know if y'all can hear it in my voice. After I got done teaching y'all on Wednesday, like my entire house had been sick, the little gremlins, everybody just sick. And I thought I had avoided it because they were sick like Monday, Tuesday, Wednesday. And Thursday, I woke up feeling like I got hit by a bus. Like I hadn't felt that bad since like 2022 when I got COVID. And so like I basically slept all day Thursday, and it's just kind of like I feel better, but it's still kind of like lingering on if you can hear it. Here's the funny thing about it though. I had to teach a class this morning, and I gave my class the spiel like, hey, full disclosure, I'm, not going to have the same amount of energy. I'm coming off being sick. And I made the joke about me being pretty sure that the bubonic plague was in my house. And I don't know if y'all have realized this, but the little AI thing is always listening, and it always emails me a summary of what I talked about. And I literally read the summary after I taught this morning. It's like, and Seth talked about possibly contracting the bubonic plague. I'm like, oh, that's just lovely to have that in writing, that this is quite literally thinking I have the bubonic plague. I know these little AI things are quite literal. So I can only imagine what this one's going to send me. Gotta love it. It's not the bubonic plague AI, okay? It's a joke. Stupid robots. Let me ask you a question here. Now that we've talked about the residential square footage guidelines, see how you are feeling. Also, just as a reminder, if you step away, make sure you put BRB in the chat. Remember, we got that 5 minutes, so you keep your cameras on for me. Here's a question. You read it. You tell me what you think here, and then we'll go over it together. Seeing a lot of no's, a lot of faults. Yeah. True or false, you added a through-the-wall heating unit to the room over your detached garage that permanently heats and cools the living space, so it can now be added to the total heated square footage of your home when you decide to sell. Folks, what is the biggest part that makes this false? Detached. That's the biggest part, but also understand that a garage is not automatically considered living space just because it has a heat source either. So, it's still got concrete floors. It's still got a garage door. That is not like finishes to the rest of the house. So even if it was attached, you're probably still not going to be able to call it heated square footage because it's not going to meet the rest of the house's finish standards. Now, when we're talking about square footage, it is a big factor when we are pricing a property, at least in North Carolina. Folks, part of our job as listing agents, while we're still sitting here talking about sellers, is to help a seller determine what we should potentially sell the property for. And so the way we do that is what we call a CMA, stands for a comparative market analysis, also sometimes referred to as a BPO, a broker price opinion. And we're going to talk about those in great detail in the valuation section down the road. But very important to understand that we as real estate brokers are not allowed to talk about the value of a property. We're allowed to talk about probable sale price or probable list price. Value is a term reserved for an appraiser. Of course, when a seller calls us up and says, what's my home worth? That's what they want to know. What's it worth? We're going to give them an answer, but we're not going to call it value. We're going to say what we think we could sell it for, what we think we could list it for. And so in North Carolina, the square footage is a big factor on how we make adjustments to the potential sales price. Some states don't worry about square footage quite as much. It's not as big as of a factor. They only look at bedrooms, bathrooms, and certain features. But also understand that it's not the end all be all. Folks, when we're working with buyers and sellers, what tier of authority are we operating in from an agency point of view? There you go. Special. Notice how I keep throwing back some of the older concepts so we don't forget them. Special agency, which means what? What does that ultimately mean if we are a special agent? Yeah. Cannot bind them to anything. Very limited authority. At the end of the day, we are more than anything advisors. So who makes the final decisions in those relationships? Yeah, the owner, our clients, buyers, sellers, they make the decisions. What am I getting at here? Even though we will perform a CMA to determine what we think a probable sales price or list price is, the ultimate decision falls on the seller. What do they want to list it for? What do they want to sell it for? And we kind of talked about in the obedience conversations we had earlier in the old car. And so one of the other things that you are expected to do is be able to calculate what a seller is going to make from selling their property. Now, folks, let me give you a couple multifaceted lessons here. We talked about credits and debits. What are credits and debits?
What you owe and what you're owed.
There you go. When we're talking about a closing disclosure or a settlement statement, we've got an itemized list of things that are credits and debits for both the seller and the buyer. Credits are we are giving you money. Debits are we are taking money from you. And so we have to estimate the seller's closing cost, meaning what do they have to pay to be able to close on this property, because they have things like loan payoffs and commissions to pay and excise tax. What's another name for excise tax? A recording fee. I'll take that one. Yeah, revenue stamps, not property tax. You got to be very careful because it is a tax on property, but it's not the same thing as your real property taxes. Okay, remember, the excise tax is also called transfer tax and revenue stamps. It is the tax that the seller pays to the state of North Carolina every time they transfer ownership of the property. Yeah, cost of doing business in the county or state. There you go. What was the calculation for excise tax? Just as another throwback lesson. There you go. $1 per $500 of
The assessed value.
of what?
The assessed value.
Not the assessed value. The sales price. The sales price. Remember, real property tax, called your ad valorem or assessed value tax, is based on your assessed value. That is an annual real estate property tax you pay every year, but excise tax is only paid when you are transferring ownership, and it is $1 per $500 of purchase price. And there you go, Tara. It is always rounded up if there's any change. If there's any change, they do not like it, and they do not follow normal rounding rules. There you go. And so here's what I'm getting at, folks. Let's say that a seller, and we'll make this a multifaceted learning point here, okay? Because this is going to be something I'm going to teach you in great detail later, but I'll give you the easy version now talking about sellers. If a seller was selling their property, we'll say a sales price of $400,000. And we were just looking at the seller and the seller's debits and credits. If they are selling their house for $400,000, would that be a debit or a credit to the seller? Yeah, a credit, because the buyer is giving them that money, so they get that. So credit of $400,000 for the sales price. If we said the seller had a loan payoff of $200,000, would that be a debit or a credit? A debit, because we got to take that money from them and pay the bank. So $200,000 loan payoff. Well, if I said that the seller was having to pay excise tax here, calculate it for me. How much is that? $800. So $400,000 sales price divided by your 500 gives us $800. Now, is that a credit or a debit? There you go, debit. So $800 for excise tax. If I said the seller is paying 6% commissions, how much is that? $24,000. Take your $400,000 purchase price, multiply by 6%, and you get $24,000. So I'm just going to call this commissions of $24K. Is that a credit or a debit? Debit, because they have to pay it. I'll just put commissions again. And then if I just said that they had other miscellaneous closing cost of $2,000, let's just throw that in there, okay? I'll just put other closing cost of $2,000. Is that going to be a credit or a debit? There you go, a debit. And so really, all that a closing disclosure is, or a settlement statement is this itemized list of the seller's credits and debits and the buyer's credits and debits. And folks, if you net them out, that's going to tell you what the seller is going to walk away with, right? What the net to seller is. If you did this for a buyer, it's going to tell you what the buyer's cash to close is. And so we do this as real estate agents by way of what's called a net sheet, what we estimate the seller will net given this transaction. And so we don't need to total up the credits because we've only got one, but their total debits are $200,000 plus $800 plus $24,000 plus $2,000 for total debits of $226,800. And if you subtract that from their total credits, that tells you what they are going to walk away with. So $400,000 in credits minus their $226,800 for $173,200. That is what we call net to seller. Now, folks, please don't think that this is profit. You cannot call this profit. Why? Profit is a correlation of what you paid versus what you made. We don't know what they paid for this property or for this house. That's irrelevant in this question. We're just talking about net. Does this make sense for everybody? So in the real estate world, this is the way that we kind of look at things. We say, here's what we think you could sell for. Here's what we think your costs are going to be. Here's what we think you're going to walk away with. However, there is the need to be able to calculate it differently, because sometimes a seller will have in their mind of, here's what I need to make. And so in other words, they will make us figure out what we need to sell it for in order for them to walk away with X. Okay, if they say, I need to make this, you have to be able to calculate it and figure out what they need to sell it for in order to walk away with a certain amount of money. Now, let me try to explain this, folks, a couple different ways, because I'm about to show you some really easy, you're not going to like it, but I'm going to show you the easiest way to do the math. Your studying has taught you that you need to study the tax section more. Yeah, taxes are fun. Folks, when we're dealing with commissions, okay, understand that the commission is off the sales price. So that always comes off the top. And so if we said that a seller had, let me kind of block this out and try to explain this a couple different ways. If we said that a seller was selling for $150,000 and we were taking an 8% commission and they had $500 in closing costs, very similarly to what we just did, you could just break it down piece by piece to see what they're going to net. So, in other words, $150,000 sales price times your, I'm trying to move this around where I can actually see it. 8% commission would be $12,000. I'm showing you how not to do it first, so hang tight. So we said, okay, well, they sold it for $150,000. We're taking out our $12,000 in commissions, and then we're taking out $500 in closing costs. This would be kind of what we just did, taking their credits and subtracting out their debits to give us what they're going to walk away with. Folks, that works if we're trying to find, the net, if we know the sales price. But if I was to say something like a seller needs to net $80,000 and they owe $200,000, what would they need to sell for in order to make that amount of money? That's a completely different equation. So I want to show you something, folks. If we're taking 8% commission of this $150,000, will the seller ever be making 100% of the sales price? No. How much of a percent of the sales price are they going to get? At most. 92. And so this makes your life so much easier when you realize that, because sure, you could calculate the commission and subtract it out, but you could also just understand that of the 100% of the sales price, they're only going to get 92% of it. So if we were to say 150,000 times 92%, that tells us what they would get after our commission's already taken out. It makes our life a little bit easier. So let me show you the actual math that I want you to understand here. I'm going to do it the long way, and then I'm going to show you the easiest way to do it. And actually, let me see if I can pull up the math packet here, because I think it'll be easier if you can see one.